Our guest today is Lee Qian, manager of the Baillie Gifford Positive Change Fund. Lee, thank you for coming into the studio.
Thank you for having me.
So tell me a bit about the fund. Where do you invest and what makes it positive change? What makes it a sustainable strategy?
So Positive Change is an investment strategy that has two objectives: to generate attractive long-term investment return for our clients, but also to contribute towards a more sustainable and inclusive future. The way we do it is by identifying and supporting innovative companies whose products and services are addressing a social or environmental challenge. So the existence of the companies that we invest in directly help to mitigate challenges like climate change or health challenges. Examples including our investment in Moderna, which everyone will be well known after the last few years as the company that has came up with the COVID vaccination that has helped us to live with the COVID-19 pandemic. So it's sustainable in our view because those businesses are helping to contribute towards a more sustainable future through the products and services they provide.
And you work for Baillie Gifford, which is famous for having a growth investment style.
Yeah.
Is that true for your portfolio as well?
Yeah, it is. We focus on growth companies and we have a long-term investment horizon like most of our equity investment colleagues at Baillie Gifford. When we think about growth, we look for companies that can double over the next 5 years. For that doubling to come primarily from revenue and profit growth rather than changing PE multiple.
And performance has been excellent since the fund launched about 5 years ago, but this year has come off a bit as growth stocks have come under pressure. I think it's down about 20%.
Yes.
So why is it that performance has been less good this year, and what drove the growth before this year?
Yeah, so I think this year we had the very tragic war in Ukraine that has pushed up energy prices, has led to higher inflation as well. We're also seeing interest rates rising around the world and some geopolitical tensions globally too. All of that have meant the market is a little bit more risk averse than previously, and as a result, growth equities have been sold off especially badly relative to the market. So there is a kind of a sell-off in growth equities that have contributed to the short-term underperformance. But over the long term, we are still optimistic about the long-term prospects of the businesses. It's notable that for the majority of the companies in the portfolio, the underlying operating progress last year have been still very strong in terms of revenue growth, profit growth. So the business are very much performing like we are expected. It's just the market in terms of what multiple they are willing to pay for those companies have derated a bit. But in the long term, the transition towards a sustainable future is a tailwind for many of the companies we're investing. The situation this year have highlighted in more detail the need for that transition.
So you're not going to change the way that you invest, given that investors can now get a 4% safe, risk-free bond yield from the UK or the US government?
Yeah, so we're not going to change our investment philosophy because of changes in interest rates. Our investment philosophy is based on the hypothesis that the transition towards a sustainable future will occur, and that companies providing solutions to our sustainability challenges will prosper over the long term. And that doesn't matter whether interest rate is at 0% or 4%. Of course, it might matter in terms of the exit multiple, and we have seen some of that. But in the long term, we think those businesses will still grow revenue and profit, and that is what we focus on.
You own some of the big pandemic winners in 2020 and 2021, stocks like Peloton or Teladoc or Beyond Meat. Do you still hold those in the portfolio? And were you caught up in a bit of a bubble in these names that was driven by this short-term boom for people working from home that actually was only going to play out for a couple of years rather than decades?
Yeah, so I think there was a thesis that the pandemic has led to a structural shift to how we live and how we work. We still see some of that playing out. Most people are working hybrid still, and with an element of working from home, they still do Zoom calls or Teams calls. So we do think there have been some behavioral changes as a result of the pandemic. For some of those companies, that continue to be the case. So we have held on to Teladoc, for example, because we believe the transition towards telemedicine is a structural growth opportunity over the long term. There will be bumps along the way. There'll be a few years where the growth might be very high and a few years where growth might be a bit lower. But over the long term, we think that the move towards telemedicine is going to be a tailwind for Teladoc. So we continue to hold that. We're still holding on to Peloton at the moment, and that has much more operating challenges. But we have met the companies, and we have metrics we want the companies to achieve for it to continue to be in the portfolio. And we have sold some as well. We sold Beyond Meat because that one just hasn't worked out as we expected. So we feel there are more exciting opportunities to deploy our clients' capital.
And what made you sell Beyond Meat? What didn't go to your expectations?
The execution of the company has fallen short of our expectation. I think they have overexpanded into too many markets with too many restaurant partners at the same time. And they were not in a position where they have the internal manufacturing capability to satisfy that requirement. We have seen them struggling to ramp up production in a way that is attractive at a unit economics level. So we have seen gross margin collapse as a result. Therefore, we feel that it's time to move on from that company.
And what other big purchases or sales have you made this year?
So we have added to a few companies where we felt the recent market volatility have presented a much more attractive valuation than before. So we added to Mercado Libre, which is a leading e-commerce and fintech business in Brazil and Latin America. The company has been performing very strongly, gaining market share, but the share price has more than halved from its peak, and we think that it's a very good opportunity to add to that company. We have also added to Shopify as well. That company continued to perform well. We have done our independent research where we asked someone to speak to 10, 20 small businesses that use Shopify or use a Shopify alternative. And the overwhelming feedback is that customers, merchants really like using Shopify, and the transition to e-commerce will continue. The share price has been off 80% from its peak, and we think it's at a very attractive valuation. So we added to that. And then one company that we sold is Alibaba, the Chinese e-commerce business, where we felt a combination of regulatory actions and some questions around culture and their ability to continue to innovate and grow has led us to be more pessimistic about its outlook, and we have since sold that investment as well.
And do you own other Chinese companies? Is this a broad play that you don't like China as much anymore, or is it specific to Alibaba?
So we don't own any Chinese companies in Positive Change, but that is not to say we will never invest in China. There's no top-down exclusion on China. It's just at the moment we haven't found a company which satisfy both our investment and impact objective in China.
So some of those companies you mentioned, so Shopify and Mercado Libre, their shares have fallen quite dramatically this year because of rising interest rates, but also maybe they went up too much over the past couple of years.
Yeah.
What do you think will be the catalyst for these growth stocks bouncing back?
I think there is a market tendency to overreact on the way up and on the way down, frankly. And I think that people now are a bit too pessimistic about the prospects of some of those online businesses. And they think that opening up of the economy would mean that people will shop a lot less online and go to physical stores. Some of that will happen, but we do think that the move towards online commerce is a structural opportunity. Around the world, e-commerce penetration is still around 10 to 15%. And in places like China, that is up at above 30%. So there's still a long way for e-commerce penetration to grow, and it's a matter of time. And we want to pick the companies which have the strongest competitive advantage that give us confidence that they will grow over the long run. So I think it will just take some time for the growth to continue, and for the market to realize that the growth story here is not over. And I think we will see a benefit from increase in revenue and profit from those businesses, and also potentially a higher multiple that the market is willing to attach.
There are 5 managers on the Positive Change team. How do you make decisions with so many people?
We have 3 investment managers and 2 impact analysts in the decision-making group. And that is to ensure that when we make an investment, both the investment prospect of the business and also its impact on society are considered. We have a general preference to back enthusiasm of sponsors and people who have done the research on the company. So as long as we have at least 1 investment sponsor and 1 impact sponsor for each stock, then that company can go into the portfolio.
Lee, thank you very much.
Thank you very much for having me today.
And that's all we have time for. You can check out more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.